Good morning to all of you. Uh, Thanks to be with us, and let me start with warmly thanks to Fabio. Thanks to accept our invitation to be here, and thank to the rector and to Francesco Biller and to our resurging Elena Carletti to be with us as well. Thanks to accept this invitation to do this webinar on August 2023. Perhaps some one of you are wondering why we pick up this day. I will say there are a couple or almost anniversary in this situation. The first one, and it's easy to recall these two intertwined stories. It's easy because it's just I have just to mention two names. First Paolo Baffi and then Fabio Panetta. Let me start from Paolo Baffi. Paolo Baffi, I would say, outstanding economist, outstanding citizen, and outstanding civil servant. Bocconi student and Bank of Italy governor. And a few weeks ago, there was some things that happened. But before to go ahead, let me give the floor to Francesco Billari, our rector, and then I will go ahead with my narrative. Francesco, the floor is yours.
Thank you very much, Donato. Welcome to Bocconi. Good morning. Welcome to our friends, alumni, to our colleagues. It's a great pleasure for me to welcome you all in this fantastic occasion of the speech of Dr. Panetta, our future governor of the Bank of Italy and currently a member of the ECB Executive Board. I will mention two reasons why today is a fantastic time. The first reason is connected to the mission of Bocconi, which is to be a positive force in society and in the economy. Basically, Bocconi wants to be an active contributor to improving the world. So we want to change the world for the better, and we do it through research, what we say, knowledge that matters, and our Dean for Research will also mention these topics. And we do it through education. When we do it through research, we think about what matters for the world, and what matters for the world is also a bridge to policy making, to business practice, to institution building, to making the world function. So it is a privilege for us to be in touch with key policymakers. Here we are speaking of economic policies at the European and at the Italian level. So having Dr. Panetta is a key occasion for his current role in Europe and for his future, but very close future role as governor of the Bank of Italy. So we are very proud to discuss these topics. Today we are speaking about disinflation, and we know the link between inflation and monetary policy, interest rates, is central. It affects all areas of our society and economy. It affects households, it affects business, it affects financial institutions, everyday lives. And we care about its relationship with economic growth, but also with inequality and inclusion. And we know that this is a very important part of the agenda of central banks. And we are very glad to have this kind of broad picture on what it means to have economic growth and inclusive growth. So first, changing the world. The second is changing Bocconi for the better. And one change we introduced was to honor even more our alumnus, Paolo Baffi. So we, during this year, we named finally the Buffy Center on Economics, Finance, and Regulation, to honor the memory of Paolo Buffy, who graduated from Bocconi in 1932, but I don't want to take away these notions from Donato's speech. And he became, as we know, the governor of the Bank of Italy. We are very proud of our alumni, and we are very proud of our research centers who bridge disciplines to tackle very specific topics. So the Buffy Center is one of them. I thank a lot Donato, Elena, and Fabio, Dr. Panetta, for being here. And I look forward to hearing what is next in this fantastic day. Thanks a lot, and have a great day.
Warmly thanks, Francesco. And the more we are going ahead, the more we are discovering anniversaries or almost anniversaries. Why I'm saying almost anniversary? Because Bocconi dedicated the center now to Paolo Buffy, but is a sort of back to the future, in the sense that in 1984, Mario Monti established the Center for Monetary and Financial Economics, and the center was devoted to Paolo Buffy at the region. And 1984, I was student, and I recall the trio: Mario Monti, Franco Bruni, and Angelo Porta. And as student, I realized that I was in a sort of enclave of an unorthodox thought. Was an unorthodox thought at the time because I discovered fiscal dominance. I discovered financial repression. I discovered the importance to have an independent central bank that was completely unorthodox at the time, not only in Italy. So there was the center that in 2008 became a center on central banking and regulation. The center has been bigger and bigger thanks to the direction of Angelo Porta. Then there was a merger in 2015, and now we have as a final name, I guess, Buffy Center on Economics, Finance, and Regulation. And on top, there is another almost anniversary, because on 4 August 1989, Paolo Buffy passed away. First name was Paolo Buffy. The second name is Fabio Panetta. I know that Fabio, dear Dr. Panetta, caro Fabio, I know that you dislike the long presentation of your CV. So let me use exactly the formula that I use for Paolo Buffy. Outstanding economist, I recall a series of articles, including American Economic Review, among other things. Outstanding citizen, outstanding civil servant, and now he is a central banker. And it's important to have today here as a central banker. And the reason is easy to recall. It's just, for me, it's easy because I have just to recall a quotation by Paolo Buffy. In 1979, he wrote, "The action of central bank are no longer clothed in silence, and perhaps never will be again. Whereas in the past silence was seen as a guarantee of independence, today this is achieved by giving an explicit account of one action." Please note, 1979 was a really prophetic, I would say, and I think that today we can skip his prudence. He wrote, perhaps, for sure. Let me quote a more recent economist. The unexpected at least for me, Nobel Prize in 2022, from Bernanke. In 2015, he wrote, "Today, monetary policy is 19% talk and only 2% action." So the share between these words means that words today are crucial, important to influence financial markets, firms, households. This is the reason why I would like to warmly thank again Dr. Panetta to be here with us. And so in order to introduce in the best way our guests, let me give the floor to the Dean for Research, Elena Carletti. Elena, the floor is yours.
Thank you, Donato. Thank you, and good morning to everyone also from my side. I'm very happy for the possibility to introduce this topic. As the rector already said, this is very much a topic which is both important for research, but very much for policy, clearly, and for the economic, for the society at large, given that ultimately the effect of monetary policy and the decision of monetary policy affects everyone's life in our everyday situations. So to introduce the discussion, I thought to go back for a second to last week Governing Council meeting and highlight two important aspects that were characterizing the meeting: the decision on the key interest rates and the communication, more importantly perhaps the decision itself, surrounding such decision. So the decision to increase rates by 25 basis points was largely anticipated. Maybe it was not anticipated, it was the other side of the decision, that was to bring down to zero the remuneration of banks' minimum reserves. Maybe we can go back to that in the discussion. But what was important was that there was a change in the communication, also related to a change in the risk assessment. So risk assessment was indeed more balanced than in the past. Downside risk to growth were mentioned, and more forcefully than in previous meeting, together still with upside the risk to inflation. Whereas these latter in the previous meetings were prevailing, this time the emphasis also on downside the risk to growth and economic outlook led to a change in the communication, which was really very important. On the one hand, it was still stressed that the future decision will be data dependent, because there is still a high uncertainty concerning both economic outlook and inflation outlook. But on the other hand, there was less emphasis on risk to inflation, and therefore there was a very important, for the first time, opening to the possibility of a pause in the increases in interest rates. So given this, given the last decision, and in particular the change in communication, today is just the perfect timing to start talking about disinflation and what we mean with this. And this is why, despite being the 3rd of August, we are all here very happy to discuss this topic. So let me, before giving the floor to Fabio, let me just make 2 points which may be relevant for today's discussion. First, how shall we think of disinflation? And second, how can we understand the monetary policy transmission? So how shall we think of disinflation and how shall we measure it? So as we all know, the ECB, how shall we measure it? So as we all know, the ECB requires aiming for 2% inflation over the medium term. Inflation is measured by what is called Harmonized Index of Consumer Prices. Let me call it headline inflation for simplicity, although it's not properly the same. This is a total measure of inflation, including also food and energy prices, which tend to be much more volatile, as we have seen in the last years. As a result, in particular, when thinking about inflation in the medium term, other concepts of inflation are considered, namely underlying and core inflation. So currently, what's happening is that while the volatile component of inflation, that is in particular energy prices, are decreasing fast, underlying inflation, core inflation, appears to be much more resistant, also due to some second round effect of increased wages, although we haven't really seen spirals in wages as some feared. So in this context, and given that I think it's now very well established that inflation in the euro area is not due to heated demand, but is rather due to supply shocks, the question is, how shall we think of inflation in the medium term? Does it make sense to keep using measures of underlying inflation when the volatile component of inflation and therefore the total index of inflation is on a disinflationary path? And what would happen if over the medium term, total inflation is a target, but core inflation, which is more sluggish, is still above 2%? So how shall we think about this inflation, given this consideration? Let me turn to the second point, monetary policy transmission. As it was clearly stated the last week, monetary policy transmission, the mechanism is at work. There is a strong pass-through on financing condition, but given also that, as we know, monetary policy operates with a lag, which can also be substantial, not just a matter of a few months, but even longer than that. The question is whether there isn't an increasing risk of over-tightening. It then becomes crucial to better understand the speed and intensity of the transmission of monetary policy. And here there are some difficulties. The first one is that if we look at the past, as we tend to do as economists, I'm afraid at this time there is not many lessons that we can use for understanding something about the future. At least since the creation of the euro, we haven't experienced a situation as today. The last monetary policy tightening was in the year 2005, 2006, but this was occurring in a completely different context. It was not a tightening monetary policy in the context of supply shock. It was not such a level of inflation. So the situation was very difficult. So it's a bit difficult to draw lessons from the past. But second, the speed and the intensity of the transmission are state dependent. What do I mean with that? In economics term, they are endogenous. So the more growth is expected to slow down, the more banks are likely to keep reducing lending and tightening financing conditions because of fears of credit risk coming up. Similarly, the higher rates are, the higher the funding cost of banks will be, which also may generate outflow of deposit, not just an increase in rates. And these altogether may lead to further tightening. And on the real side of the economy, of course, ultimately the last piece of inflation is the way in which firms are changing prices, and how it was highlighted also in the paper by Lippi and Sintra. The stickiness in changing pricing by firms will also be dependent on economic factors. So all in all, monetary policy transmission is clearly endogenous. And therefore, how do we think about evaluating disinflation and the impact of monetary policy because of all these complications? So it's a very subtle line. On the one hand, keep fighting inflation and what we mean with inflation, what inflation shall we look at in particular? And on the other hand, recognizing the importance of the implication, the impact of monetary policy with the lag, with all these endogenous variables, and how to measure this impact. With this in mind, let me stop. Let me give the floor to our speaker, Fabio, and let me thank him also from my side for being here today.
Good morning. Thank you, Professor Billeri. Thank you, Professor Masciandaro. Thank you, Professor Carletti. Before I start, I wish to thank Bocconi University and the Paolo Baffi Center for inviting me. It's a pleasure to be at Bocconi, which is now one of the top universities globally. I also want to thank Professor Billeri, Professor Masciandaro, and Professor Carletti for the enthusiasm that they have shown in participating to this event, because I think it is clear that in order to participate in a seminar on the 3rd of August on monetary policy, you do need some enthusiasm. And one comment before I start my talk, Paolo Baffi was a legendary figure. He is a legendary figure for central bankers and economists. And I don't think that I can be compared to him. The Latins would have said, si parva licet componere magnis. We cannot compare a small thing to a big one. But I'm still very flattered that someone, even though a friend, thinks that I could be compared for once to such a prominent figure. My talk today will be on disinflation, as Elena mentioned, on how the European Central Bank should adapt its disinflationary policy to the prevailing European economic and inflation outlook. This is, of course, a burning issue. My comments will be based on a broader text that has been published at 11:15 on the website of the ECB. So if you want to go deeper and see the details of my comments, you can refer to the speech on the website of the ECB. And I will use slides. So let me start. In recent years, the euro area has been hit by multiple simultaneous adverse supply shocks. These shocks have combined to create an inflationary shock of such magnitude and persistence that inflation risks becoming entrenched. These developments coincided with a phase of highly accommodative monetary policy. To avoid exacerbating inflationary pressures by stimulating demand and to prevent the de-anchoring of inflation expectations, the European Central Bank rapidly normalized its monetary policy stance. In parallel, the end of net asset purchases and investments under the asset purchase program, coupled with the repayment of our targeted longer-term refinancing operations, is making our balance sheet shrink considerably. With policy rates now firmly in restrictive territory, setting and communicating the direction of monetary policy has become more complex. Our monetary stance needs to be calibrated in a way that brings inflation back to target in a timely manner while avoiding unnecessary harm to economic activity. This is a fine line to walk, as the effects of monetary policy emerge with a lag. While our past decisions have already led to a material tightening in credit conditions and loan dynamics, their effects have yet to be felt in full across the real economy. At the same time, inflation remains elevated. Even if it is now falling as the effects of adverse supply shocks begin to fade and weaker growth eases price pressures, it will still take some time to reach levels compatible with price stability. In order to successfully complete the disinflation of the European economy, we now need to flexibly adapt our policy to the evolving inflation outlook. In the current context, where policy rates are around the level necessary to deliver medium-term price stability, I will argue today that monetary policy may operate not just by increasing rates, but also by keeping the prevailing level of policy rates for longer. In other words, persistence matters as much as level. This raises challenges for steering our policy stance. I will argue that our data-dependent approach, underpinned by our firm commitment to returning inflation to its target, is well equipped to navigate these intricacies. Let me now start by recalling how inflation spread throughout the European economy. Euro area inflation is largely due to a series of supply shocks, notably the pandemic-induced supply chain disruptions and the energy shock triggered by Russia's invasion of Ukraine. In 2022, energy prices were the main driver of inflation, as shown in chart number 1. The energy shock translated into broad-based price pressures, given the impact of rising energy prices on all components of inflation. Headline inflation across euro area countries is mainly correlated with energy considerations rather than with the strength of domestic demand, as shown in chart number 2. While supply shocks are now unwinding, their lagged effects on inflation are still being felt as past increases in input costs are passed on to consumers. The dynamics of core inflation is a case in point. Chart number three, okay, indicates that the contribution to core inflation of higher input costs stemming from supply chain disruptions and the energy shock only peaked last March. Furthermore, as shown in chart number 4, movements of producer prices influence retail prices with a delay of some months. But there are also other factors at play. The reopening of the economy after the pandemic provided a boost to consumption in the summer of last year, with a significant shift in demand towards services such as travel, hospitality, and restaurants. Such sectoral demand-supply imbalances, coupled with the uncertainty generated by high and volatile inflation, have in turn allowed some firms to raise their profit margins. In this context, even though we were not facing generalized and sustained excess demand or a significant reduction in production capacity, we recalibrated our policy for 3 main reasons. The first was to avoid monetary policy adding to inflation risks. The second was to anchor inflation expectations. This was necessary to minimize the cost of our disinflationary policy and to avoid a wage price spiral. The third reason was to contain the risks connected to the strength of the labor market, which had raised concerns that a wage catch-up could turn into a self-sustained and destabilizing process. Let me now illustrate the shift in the balance of risk that has occurred in recent months, also in relation to the ECB policy tightening. The factors I just mentioned that were initially driving our actions, the actions of the European Central Bank, have now diminished in intensity. The first reason for this is that the process of disinflation has been set in motion. It has been set in motion, pushing inflation expectations down. From March onwards, we have observed a consistent decline in consumer expectations for inflation over a 12-month horizon. Likewise, firms' expectations regarding their selling prices have markedly decreased from their peak of last year, as shown in chart number 5, which should appear anytime. Okay. Moreover, long-term inflation expectations derived from surveys have remained largely stable, mitigating concerns about a wage price spiral. The second important development is that the risks to inflation are becoming balanced. Charts number 6 and 7, okay, show that supply chain pressures have substantially abated compared with last year. And commodity prices have fallen, although persistent upward pressures on energy and food prices due to geopolitical tensions and climatic events could reverse this trend. Falling energy prices have already pushed headline inflation lower. The next chart, chart number 8, which should appear, chart number 8 shows that energy inflation, which had surged to 44% in March 2022, is now negative. Moreover, chart number 9 shows that the proportion of items in the consumption basket which have a higher annual inflation rate compared with the previous quarter has fallen from 80% to 30%. The data are less reassuring for the services sector, where inflation is still rising owing to robust spending on holidays and travel and base effects. Although core inflation is still elevated and is projected to remain around current levels throughout the summer, empirical evidence suggests that it is a lagging, not a leading indicator of inflation. In other words, looking at core inflation today does not tell us much about headline inflation in the medium term. The third factor that is changing the balance of risks in the euro area is the deterioration of the economic outlook. Downturn in the euro area manufacturing sector intensified in July, with the manufacturing PMIs falling to its lowest level in over 3 years. In the services sector, activity continues to expand, but it is doing so at its slowest rate since the start of 2023. The Citigroup Economic Surprise Index, shown in the next chart, chart number 10, exactly, indicates that in recent months, the euro area registered mostly negative surprises. In this context, if downside risks to growth persist and materialize, high wage growth is less likely to be sustained. In turn, the decline in inflation could contain wage demands, and high profits may help absorb them. And if firms start to anticipate a drop in future demand and labor needs, the economic strength represented by firms' tendency to hoard labor could turn into a vulnerability. Let me now concentrate on the monetary policy implications of my analysis. The current juncture is particularly challenging, given that the effects of our past tightening are yet to be felt in full. We have clear indications that our monetary policy is being transmitted strongly to monetary and credit conditions. As shown in the next chart, chart number 11, money growth has fallen dramatically, and both nominal and real rates have increased considerably since the start of the tightening cycle. In the credit market, both quantities and rates have reacted to our tightening much faster than in the past. Our bank lending survey finds that firms' demand for loans is at its lowest level in 20 years, while the tightening of lending standards since the start of the hiking cycle has been very substantial. These indications are consistent with the ongoing sharp deceleration of credit aggregates shown in chart number 12, which is coming. Exactly. This is the deceleration of credit aggregates. Moreover, rates for loans to firms and households are now at their highest levels since 2008 and 2012, respectively. Given these developments, we must be prudent in calibrating our monetary policy stance if we are to reach our inflation target without harming economic activity unnecessarily. It is possible that the transmission of our monetary policy might be even stronger than the staff projections indicate. In addition, the tightening of monetary policy is being amplified by international policy spillovers. All major central banks are tightening. In these circumstances, our disinflationary monetary policy may be conducted by combining different approaches. One approach, that I will refer to as the level approach, entails going higher than where the policy rate is currently, with the risk of then having to cut earlier and faster, as implicit in investors' expectations about the future interest rate path. Another approach, that I will refer to as the persistence approach, instead advocates delivering the same degree of overall restriction while avoiding ups and downs, namely by keeping policy rates at the prevailing level for an extended period. Emphasizing persistence may be particularly valuable in the current situation, where the policy rate is around the level necessary to deliver medium-term price stability, the risk of a de-anchoring of inflation expectations is low, inflation risks are balanced, and economic activity is weakening. Under such conditions, relying solely on an aggressive approach to rate hikes might amplify the risk associated with over-tightening, which could subsequently require rates to be cut hastily in a deteriorating economic environment. The persistence element can mitigate this risk, giving the central bank more time to assess the lagged effects of its past policy measures and fine-tune the calibration of its stance as new information comes to light over time. This breathing space is crucial, given that, as I said before, the transmission of our monetary policy may actually turn out to be stronger than our projections indicate. Moreover, favoring persistence would be in line with our previous proportionate response to the evolving challenges to price stability. However, emphasizing persistence might pose communication challenges. It might give rise to concerns about the effectiveness of our monetary policy, or it might prompt worries that persistence could simply amount to delaying tangible actions such as rate hikes in favor of a strategy of keeping rates higher at a later stage. Countering such misconceptions would require clear communication by the ECB. We need to explain that the same degree of restriction can be delivered with different combinations of rate levels and persistence. By determining the duration of a specific policy rate on the basis of incoming data, we can use persistence as a dynamic stabilizer. This would enable us to flexibly adapt our stance based on evolving risks without having to take decisions that might be then reversed at a high cost. This adaptive methodology aligns seamlessly with our dependent approach, and of course, should the inflation outlook materially deteriorate, a further rate adjustment would be warranted. Let me briefly conclude. Calibrating monetary policy has become increasingly complex. We are at a juncture where inflation is falling with fading supply shocks, but past monetary tightening has yet to be felt in full. With rates now in restrictive territory, monetary policy needs to be calibrated in a way that allows us to reach our inflation target in a timely manner while avoiding unnecessary costs to the economy. So we need to get this inflation right. To this end, when steering the monetary policy stance, persistence is becoming as important as the level of our policy rates. This is particularly true given that risks to the inflation outlook have become more balanced, while risks to the economic outlook have shifted to the downside. A stance that incorporates persistence offers greater scope to flexibly adjust our policy in light of the incoming data, while crucially leaving no room to waver in the fight against inflation. And indeed, let there be no doubt, we are fully committed to bringing inflation back to our target in a timely manner. Thank you very much.
Thank you very much, Fabio. This was a very clear message and an important change again in the way in which the ECB should start thinking about inflation, not just at the levels, but also at persistence, and should use a combination of level, persistence, assessment of the three indicators that the ECB since March now is looking for: the data dependency, that is inflation outlook, dynamics of underlying inflation, and strength of monetary policy transmission. And you made very clear also that the transmission of monetary policy may be stronger than what current projections or current data show because of the lag also of monetary policy. Maybe we still have time for questions. Maybe let me start with the question and then I leave the floor to Donato. And the question that I have is, while I'm fully seeing and agreeing with your point that the risk to inflation have become lower, while the risk to the downturn in economic for the economy are more important, and therefore it is time, as also last week it was mentioned, maybe to pause and to look at the persistence going forward rather than the level and the level increase. We have seen, although in a completely different circumstance and context, but we have seen a similar approach in the United States, meaning that there has been a pause and then an increase again in the rates. We know that the context is completely different. There is really driven by demand. Here it's not driven by demand, but by the supply shock that, as you clearly said, are diminishing in importance, and therefore the situation is completely different. But nevertheless, for the communication, how shall we think about now indicating the possibility of a pause, the possibility of adopting this new persistent approach, and maybe in September, in October, or later on, if there would be a reverse, meaning the upside risk to inflation would become again more prominent, and we would need, as you said, increase rates again. How shall we think about it in terms of communication in particular, and coherence, if you want, of the monetary
Thank you,
policy?
Elena, for your question. I think it is very important.
Sorry, Fabio.
Yeah.
I'm wondering, given that we have also a question by Francesco.
Yep.
I'm wondering if you would like to listen both question and then to reply. Personally, let me say just two telegraphic things in terms of first methodology. Usually, monetary policy textbooks tell us that a good central bank speech is a speech in which the central bank explains monetary policy. And let me say that on this point of view, you has been today particularly transparent and clear. And now we have one more keywords as compass for our analysis, and the word is persistence. And this is for me is important, and this is an important news of today's speech in terms of explanation. But let me give the floor to Francesco.
Thank you, Donato. Inspiring speech. I'm a professor of demography, so my qualification on monetary policies are certainly extremely low. I'm thrilled by the persistence idea. It seems to me that finally there is both a slow and fast approach, so short-term and long-term approach, and you have discussed this idea. This is clearly relevant as we go on in a world where, let's say, again, demography is probably a threat to economic growth. In some cases, the population, we don't know much about the consequences of population aging because it's a new phenomenon. But there is also generative AI, where disinflation is one of the potential long-term effects, and there are unclear distributive effects. So I'm wondering whether this is gonna stay in the long run, the persistence approach, and it's also compatible with the way we have to view economic growth and its distributional impact, both short and long run, both fast and slow. Thank you.
Well, thank you for your questions, which help me clarify the way I see monetary policy going forward. First, your question, Elena. Should we pause? My speech is not about pausing or not. Personally, whether we should pause or not, I will decide in September in the Governing Council, which is the proper setup to take this decision, to make this analysis, but also because in September we will have more data on inflation, on growth. We will have a new round of projections. So I would find, as I tried to argue in the past, very difficult to commit now to pausing or not pausing. The objective we have is to bring inflation to 2%, and we will do it. Now, the problem is how to do it. My speech is an effort to provide some methodological thinking behind what the ECB might do in the coming months. And I guess that the gist of my speech is that what matters for monetary policy, excuse me, is not just the level of interest rates today. It is the entire path of policy rates today, tomorrow, a week from now, 3 months from now, the entire term structure. So the idea that we may only act by hiking or not hiking, for me, is not correct. we know that the market yield curve expectations by investors expect that we might now, with lower probability than 20 days ago, because a month ago, because of the data, because of the press conference of the president, because of the decisions taken by the governing council, markets in any case expect that if the ECB hikes, then there would be a fast reduction. But of course, these two movements would be in opposite directions. The hike would be a tightening, the fast reduction would be a loosening. So maybe there is a more efficient way to do monetary policy in case you need to hike, or in case you don't need to hike, by trying to leverage on not only interest rates today, on the action of the central bank, but also on expectations and on the term structure. So my comment is that given that the level of the terminal rate, the so-called terminal rate, that is the peak of the interest rate, which will ensure that we get back to 2%, to our target, in a timely manner, given that this terminal rate is uncertain, nobody knows if hiking or not is the correct choice. So I think that in a phase in which inflation is decreasing, the economy is deteriorating, we have uncertainty on the terminal rate, we might want to expand the tools we could use, and try to leverage not only on our I would say proactive measures, but also on market expectations, because what matters, I can say, the integral below the yield curve. So we should not stick only on one of those dimensions. And I think that it might be more efficient to leverage on both dimensions. Donato, you're absolutely right. I try to, even though again, the comparison between Paolo Baffi and myself was a big exaggeration, was improper. So thank you very much, but I tried to give a methodological contribution to the discussion. So I did not say anything about, let me emphasize this again, about whether we should hike or not. I think that this exercise of trying to give a preview of what we will do in 2, 3, 4 months from now is, for me, counterproductive, because we know that the economy is changing very fast, and there are so many exogenous factors that are influencing the economy, inflation, financial markets, that it's very difficult to make a forecast for a distant future. I've never seen in my life a pandemic. I have never seen the consequences of the pandemic. I was not expecting in my life to see war in Europe, and I cannot make accurate or even inaccurate forecasts on the consequences and the fallout of a war near the borders of Europe. I've never seen in my life supply bottlenecks to the extent we have seen in the last few years. So the idea that we decide in advance, as if we were in a normal condition, as if the world was behaving in a way that we could forecast based on past regularities, for me, is not correct. So I'm just saying, let's be careful, let's be prudent. We will do whatever is necessary to do to bring inflation back to 2%, but we have to do this at the minimum cost for the real economy, because we know that the economy is weakening quite fast. On your last question, Francesco, well, first of all, I'm sure your economic background is stronger than my demographic background. Okay, but demography is a very important element for monetary policy makers, because it's one of the important factors behind the evolution of what economists call the natural rate, R star. That is the interest rates that in equilibrium central banks should have in mind to fine-tune their policy. And there are many factors that are at the same time influencing this natural rate. You mentioned two very important ones. One is demography, and the other one is technological innovation. You mentioned AI, but there are other innovations which might influence productivity growth. And there is tension between demography, which is probably, at least in advanced economies, pushing towards a lower R star, and technological innovation, which might boost productivity and push in the opposite direction. So it's a tough job, and there are many elements that we must keep in mind to design our future policy. And I think that this is what makes our job fascinating.
Thank you very much, Fabio. We are in time. We are still 9 minutes. So I'm wondering if you can decide to answer or not. You stress that it's important is this moment the calibration of monetary policy, try to normalize, minimize the risks of any economic cost. In this normalization, there has been a decision last time of the council that has been no comment so much in the media. So I'm wondering if you will just to explain this story in the few minutes that still we have. In other way, you decide to set the remuneration of the minimum reserve at 0%. In order to have a more efficient transmission mechanism and the likes. I'm wondering if you would like to comment this one more move in terms of normalization. In any case, thanks.
Thank you very much, Donato. Yes, of course. It was a decision taken by the Governing Council that starts from an uncontroversial point. That is, in order to run monetary policy, central banks must have positive capital. We know that in theory, it's not necessary. It's not true in theory, but then if central banks do not have robust capital buffers, then over time their independence would be at risk. So given that we are in a phase in which we are normalizing monetary policy by, starting from very low level of interest rates, the idea that we would continue to remunerate required reserves was not necessary anymore. So was, in my view, an unnecessary transfer of resources that would have made our policy less efficient, not more efficient. And this was the decision by the Governing Council. It was a monetary policy decision, which was necessary in a phase in which we have normalized our policy rates.
Absolutely. And I imagine that for you now, the target is to monitoring the overall evolution of the banking reserves as a whole, given that, if you compare the situation today to the situation before the starting of the Greek crisis, 2008, the dimension of the banking reserves is quite more different. I imagine that there is this decision, but in general, I imagine that you are monitoring the evolution, as you said, in the medium run of the overall banking reserve story.
Yes, that is the mirror image of our balance sheet. Of course, when interest rates were at their floor, when the policy rate was at its effective lower bound, we used the balance sheet. Central banks around the world, not just we, the Fed, the Bank of England, use the balance sheet as a policy tool. And now we are going the opposite direction. And there's, of course, what is an asset for the ECB is a liability for the bank and vice versa. So what you are alluding to is the mirror image of the quantitative tightening that we have started. That is, we are withdrawing part of the liquidity which was injected at the lower bound to support the economy, especially after the pandemic. And let me emphasize this. This decision was necessary to avoid that a very pronounced recession could evolve into a depression. And we have avoided that. And the ECB has intervened, and we have avoided that. And we have taken other important and courageous decisions afterwards. That is, when we started to normalize monetary conditions and liquidity conditions, we decided a very important measure, the TPI, the Transmission Protection Instrument, which has made the ECB, the euro area, look like a quasi-normal jurisdiction in monetary terms, because we have hiked quite rapidly, quite substantially, without major implications for member states. And this is very important. This is another important decision which has been taken by the ECB. First, the first one, expanding the balance sheet to avoid a prolonged contraction that could evolve into a depression, and then to create the conditions for the tightening, and that was the case. Now inflation is coming. I hope it will continue along the same direction. This is what the numbers, the data, the information, the economic information tell us. But of course, we will react, as I said before, to incoming information. We will be data dependent because the degree of uncertainty in the economy is so high that that's the only mode in which you can sensibly run monetary policy these days.
Dear Fabio, I introduce your long CV with three words: economist, citizen, and civil servants. Let me say that you are both today both a European and Italian civil servant. So I feel that you are doing a double job in this week. Please let me recall you that this is August. And I hope that you can do three jobs: European civil servant, Italian civil servants, and a member of your family at least.
Absolutely. And if I don't go to holidays, the third one member of the family would be at risk. The other two have been insured now for a few years, but the third one is not to take for granted. So I will follow your suggestion.
Thank you, Fabio. I'm wondering if Elena and Francesco would like to close. Okay, I could close this fantastic August 23 workshop.
You could close.
Thank you very
Thank
much.
you very much.
Thank you.
Enjoy.
Thanks a lot.
Thank you.
Bye-bye.
Bye.